Long options are for speed. Credit spreads are for probability. If you don't know when to use each, you're leaving money on the table. Let's fix that in today's video. What I'm going to outline for you is when we use the long options and when we use the credit spreads based off of some key metrics. The issue that I see with so many retail traders right now is you have this big divide between our long option traders and the credit spread traders, and you feel like you have to fall into one camp or the other. In our opinion, as active options traders, I want to have the flexibility to use both. I want a full toolbox knowing that market conditions will change over time. There's going to be a time where the long options work really, really well. There's also going to be times where the market isn't as active. We're in more of a choppy environment, or I'm less confident of a big directional move coming. That's where the credit spreads fill an important spot on my watch list and my trade plans because it allows me to make money even when the market is not in a volatile environment. We all love trading long options. There's a lot of benefits to them. I trade long options all the time. I'm not saying you shouldn't ever buy an option, but I want to make sure that the market's given us the green light to do so first. And here's what I look for. Let's go ahead and take a look at the long options first, and then we'll transition on over to the credit spreads. That's the big question. It doesn't typically take me a lot of work to get people convinced that you should consider credit spreads. The question comes in is, when do you use them? What is the best condition for using that strategy? So let's start with the long options and then we'll get into the credit spreads. So the key here with the long option, obviously, when we're buying a long option, we have to have a pretty strong directional opinion. If I buy a call option to lean on the bullish side, I got to be very confident that the conditions are right for a big directional move to the upside because that's the only way I'm going to make money. Same on the downside. If you lean more to the bearish side, we can always come in and buy long puts, but if you're going to do that, you've got to have a very strong opinion that that move lower is going to come and it's going to come quickly. Right? The objective is to benefit from those big directional moves. When they work, you're looking at potential 50 to 100% returns immediately. It's going to be the higher risk, higher reward portion of your portfolio. I don't want you to go all in on buying options because, as I mentioned, there's going to be windows of time where the market just isn't conducive for it. You're in a choppy stretch. Volatility is much lower. That's where you want to commit to taking what the market is giving us. Now, the key with any strategy, whether you're buying an option or selling a credit spread, I want to know what my max risk is right up front. Everything that we teach at NetPicks is fully risk defined. We know that we're in a very news sensitive environment these days. Headlines can break at any point in time. We can see social media posts out of the president, and all of a sudden, we've got these big moves that come out of nowhere. I want to know what my max risk is on every trade that I take before I ever pull the trigger on a trade. Now, when we take a look at the long options, again, if we're expecting those big directional moves, that can be a nice environment. If you're anticipating volatility picking up, if you're in an earnings season, for example, if you're in a stretch where you've got Fed news on interest rates coming out, if the expectation is there that there's catalysts that could potentially move the market, I don't have a problem taking those long options. The nice piece here is we know that with tech, with AI dominating markets, after some of these moves higher, some of these big tech stocks, they're expensive. The nice part about trading long options, we can still take the directional bets, but we're doing so with far less capital when just buying the stock outright. Really nice feature. That's why we love to trade these markets. And it potentially allows us to benefit from a wide range of outlooks, right? Short term, long term, there's things that we can do in each environment. But I want to take this a step further. I want to give you some exact metrics that we look at on our side, right? Because so far it's been pretty general, right? Have a bullish or a bearish outlook, try to buy the calls and puts when you're expecting a big directional move. But when it starts to get into live markets and it's time to pull the trigger on a trade, you want to know that you have some metrics and some numbers there to back up the decisions that you're making. Here's what I like to look for with the long options. I like to see the VIX between 18 and 23. I like to see the IV percentile or the IV rank below 35. And I like to see the SPY daily ATR between 6 and 8. Now we break that down for you here in a little bit more detail. When I see a VIX between 18 and 23, that typically comes when the market has a little bit more uncertainty. Potentially you're looking at a move to the downside or coming off of a move to the downside where the market has been more active. You're seeing bigger swings. That is going to be more conducive to the long options. Some people might say, well, isn't that an environment where the options are a little bit pricier? Yes, but that they're pricier because the market has been more active. That's what you need. You need the movement, right? I don't mind paying up a little bit for those options as long as I know the markets are very active. We tend to see the best results when the VIX is between 18 and 23. Not required. You can certainly trade long options when the VIX is lower. You just have to know that when the VIX is below 18, you're typically looking at a slower moving market. That could be a market, or maybe you want to go a little bit further out in time because you're not getting those quick daily swings. Right? You can react to those slower conditions. I'm just giving you what we have seen from our data from hundreds of trades that we've taken over the years. We tend to see the best results when the VIX is between 18 and 23. Now let me go over for the next two so I can show you these in real time in a platform where you can see the prices, you can see the numbers. So let's go ahead and move on over to Thinkorswim. So I've simply loaded up a daily chart of SPY. I have a variety of different moving averages up top. And then down below I've got the volume and I've got the ATR. That's the average true range indicator. No custom settings here, very simple, straightforward settings. And what I'm looking at here is I want to see the ATR, the average true range between 6 and 8. That's where we see the best results as well. That's indicative of a market that's pretty active. You're getting consistent swings on a daily basis. When you start to see an ATR below 6, you can still make it work. But there again, things are a little bit slower. If you have an ATR at 4 or 5, for example, you just have to go a little bit further in time. You're not getting those quick moves that we like to see that are going to produce the best results with the long options. Now, I also like to take a look, because I'm in Thinkorswim, we're going to take a look at the trade page, and I'm just going to load up a symbol here. We'll load up Apple. And down at the bottom of the trade page, you're going to see a section for the today's options statistics. Now, we're going to take a look at the IV percentile. If you're looking at a platform like Tasty Trade, they have IV rank. And all it's simply doing is taking a look at implied volatility in more detail. When we take a look at how an option is priced, it's not simply based off of whether the stock is moving higher or lower. There's other inputs that can impact price. And one of those inputs, one of the big ones, is implied volatility. When volatility is high, the options are more expensive. When it's low, they're cheaper. But I want to put some context around it. In this section on the left-hand side here, you're going to see the current level of implied volatility is 26. How do I know if that's high or low? 26 might be high for some products, might be low for others. This is where we take a look at the last 52-week range. And up top, you're going to see the 52-week high for implied volatility on Apple is 71. The 52-week low is at 19. What it does is it takes the current level of implied volatility at 26, it slots it into that 52-week range to tell us how often have we been higher or lower than the current level. With the IV percentile sitting at 13, you can see we're near the lower end of the range. The options are cheaper than where we have seen them over the past few months. What I ideally want to see with the IV percentile, I want to see it below 35. I don't want to see it at 0, but I don't want to see it at 60 either. The lower the implied volatility, the cheaper the option. Seems like that's a good thing if we're buying an option. It's cheap, but the trade-off there is it's cheap because markets have been slower. We haven't seen the movement back and forth. Remember, I need movement when we're buying an option. The IV percentile needs to be below 35. I don't want to pay up for it. If we see the IV percentile above 35, I'm more interested in selling a spread because now I'm collecting premium up front. I'm taking advantage of the high volatility. But if the IV percentile is below 35, I'm okay buying an option. In many cases, it can work out really well because you're getting it at a decent price and it does give you the ability to make money from those directional moves. Now, like I said a few moments ago, these metrics, are they required? They're not, but they're going to drastically improve your odds long term. We're very numbers driven at NetPicks. We take a look at all of our trades over time and we take a look and we dissect them to say, okay, what is going to produce the best results for us going forward? What metrics are going to produce the best results? I'm not interested in grabbing every little swing back and forth. I know it's not realistic. I'm looking for the best trades and the best metrics to set me up for consistency in a wide range of market conditions. Now let's talk about the credit spreads next. And if you're not trading credit spreads at this point, highly recommend that you take that next step. It was a game changer in my trading. I know it's a game changer for a lot of other people as well. Can you take it even further? Can you go into the iron condors, the butterflies, the straddles, the strangles? There's a lot of advanced strategies out there that you can use. And I'm all for it, but at a minimum, I want you to trade long calls, long puts, and simple credit spreads. That's going to allow you to react to a wide range of market conditions. And then beyond that, if you want to add in some of the others, perfectly fine. I'm all for it. But at a minimum, you need to add the credit spreads. Just simple call and put spreads. So when I talk about a credit spread, all I'm simply referring to is trading two options at the same time. And we do have some videos on our YouTube channel that cover the credit spreads in more detail. If you're looking for more of a comprehensive training on how those strategies work, make sure you visit that content on our YouTube channel, and that'll help get you up to speed and get you some criteria in place that you can use right away. So what I'm looking for here, a lot of times people get intimidated because they think, hey, if I'm selling a spread here, I've got a large amount of risk, it's more advanced, I leave myself exposed to larger losses, when in reality, the credit spreads are actually much safer than buying the long options. They're going to tie up less capital in many cases, and instead of only having one way of making money, like we talked about with the long options, with the credit spreads, you're going to give yourself 5 ways of making money. So now you've got multiple routes to follow to make money. You're not solely dependent on those large directional moves taking place. And best of all, it's still fully risk defined. You know what your max risk is right up front when you put a credit spread on. And the big key here is down in the lower right corner. You're taking advantage of the time decay. When you buy an option, it's a decaying asset. You're holding a ticking time bomb. The more time passes, that option's losing value, and you're fighting that. As long as the stock moves in your favor, it's okay. You can offset it. But with a credit spread, now we're putting it in our favor. Every day that passes, that option's losing value, and that puts us into a profitable trade with a credit spread. Really, really key distinction. That's why we love to have those credit spreads in place. It's when the market gets choppy, where a lot of traders are just really frustrated. You're just spinning your wheels. The market's not moving. With a credit spread, I don't really care. I can still make money from that time decay adding up each and every day. Now, when do we use the credit spreads? If the anticipation is there for a large directional move, 100% you're going to make more money from buying a long option. If the market's active, if you start to see the metrics that we just referred to over the past few minutes, I'm all for buying the long options. But if there's ever a time where you're a little bit less certain, markets are slower, you're seeing the metrics tell a very different story, where you're seeing a choppy environment, that's where the credit spreads allow you to stay active. Or if you're simply looking at a product where the options are too expensive, take a look at some of the big tech stocks. I want you to keep your risk between 2 and 5% of your account per trade. On some of the more expensive tech stocks, it's hard to do with a $5,000 to $10,000 account, right? The credit spreads can give you close to a 60% cost reduction in some cases when compared to buying a long option, drastically reducing the cost of the trade. So don't, a lot of times people ask me, what's the split, Mike? I mentioned a 50-50 split. Should you look at 50% of your trades with long options, 50% with credit spreads? A lot of that's going to be trader dependent, and it depends on your risk tolerance. For me personally, I am typically around 80-20. 80% of the trades that I take are credit spreads, 20% are long options. I like the credit spreads there because they give me a higher win rate. I tend to be more of a conservative trader anyway. I like the higher winning percentage. Even though I'm giving up the home run profit potential, I'm okay with that for the more predictability out of that strategy. The 20% of my portfolio in the long options, that gives me the opportunity to get a little bit more aggressive. Swinging for the fences, knowing that I'm going to have a lower win rate, but the trades that do win give me a higher return. So now I get the best of both worlds. I'm not saying you need to be at that same 80-20 split, but as long as you have a mix of the strategies in place, that's the key. That's what we're looking for. Now, here's some metrics on the credit spread side. They're easier to use when the VIX is above 14. When the VIX is above 14, the options are more expensive. The market's pricing in uncertainty. What do we know about uncertainty in the market? When the VIX gets elevated, it tends to last a couple of days, maybe a couple of weeks. Oftentimes, it's short-lived. The market prices in uncertainty, prices in the worst case scenario, and when that doesn't play out, what happens? Volatility contracts. Markets normalize. When volatility contracts, you're going to fight that with a long option. With the credit spread, you're benefiting from it. That volatility contraction allows you to make money with a credit spread, right? When the VIX is above 14, that's typically when we see the best results. Can you sell a credit spread with the VIX at 10, 11, 12? Sure, not a problem. You just have to sell an option with a strike price closer to the stock price. You're taking more directional risk at that point. Not a deal breaker. I'm just giving you the metrics that have produced the best results for us over time. And then along those same lines, I'm looking for an IV percentile or an IV rank above 30. Anything above 30 tends to represent an environment where the uncertainty is being priced in. Again, the options are more expensive. Do we have to wait for these two metrics to hit? Not necessarily. It's just that's what's going to produce the best results for me. Can you sell a credit spread in a low volatility environment? Yes. But when you do that, it tends to be a trade that's more focused on the directional aspect, right? You're either focused on either a directional move or the time decay helping you. You're not really getting the benefit of volatility contraction at that point. When volatility is already low, you don't have that benefit with the volatility helping as much. Now, when we take a look here, just to compare and contrast here, again, with a long option, both on the call and the put, you have a bigger profit potential. You just need more to go right. So I'm not trying to scare you away from those trades. I have long calls and long puts on right now on my own account as we speak. I have them on. They're just a much smaller part of my portfolio. When they work, when that directional outlook plays out in your favor, you're going to be rewarded for it. So I want to have that part of my portfolio. Either way, both trades are risk defined. That's the key point here. Are there strategies out there selling a naked option where you can make more money? Yes, you're just taking on more risk. I don't want to take that. In this market, with headlines breaking at all times of day and night, I want to know what my risk is right up front. I sleep better at night, even though I know I'm giving up a little bit of profit potential. I'm gladly doing that in exchange for knowing my risk. Now, the key differentiator here is when you buy a long option, that time decay, it's working against you. You're fighting that. I'm okay with that as long as you have a directional outlook that plays out in your favor. The credit spread, now all of a sudden the time decay is our friend. That's why I love them. That's why, hands down, the credit spreads are my favorite strategy as an active trader. Complexity, are the long options simpler? Yes, no way around that. Don't be intimidated by that, though. Don't be scared away from the credit spreads. They're really, to dumb it down here, we're just trading two options at the same time. There's nothing overly complex about them. Again, we've got that video on our YouTube channel. Take a look at the credit spread videos. It'll walk you through in more detail how they're structured, how to put them on, and we can get you a plan in place that you can take advantage of. With the long options, yes, you're going to pay more for them. The credit spreads, you get a drastic cost reduction. I have certain names on my watch list. Costco comes to mind. It's $1,000 stock. The options are expensive. I like to use credit spreads because it allows me to better control my risk. The credit spreads are going to give you in many cases a 40 to 60% cost reduction when compared to the long option. That's a huge advantage as a retail trader. You're going to better be able to control your risk and potentially open up markets that with long options maybe you're not able to consider. Right? So it really opens up the universe of products that you can potentially trade. Now, selecting the right strategy is absolutely crucial. It's really important to have a system in place that's helping guide your decision making. Notice I gave you some very specific metrics today, right? I'm very rules-based, as we all are at NetPicks, because I know when I don't have those rules in place, now I'm basing my decisions off of emotion. And when I base decisions off of emotion, I am an awful trader. I want to have a system in place that gives me a very defined outlook. I know exactly where to get in, where to get out, how to control my risk. It's a huge advantage. If you don't have that in place, let us know. We'd love to connect. We actually have a link in the description of the video. Go ahead and click on that link. We can get you some more material on some of our favorite approaches to this market. Now, risk management, regardless of whether you're trading long calls, long puts, credit spreads, risk management, absolutely crucial. As much as I love the credit spreads, if not used properly, if you're throwing all your eggs into one basket, just swinging for the fences, yes, it can get painful in a hurry. We recommend keeping that risk at 2 to 5% of your account per trade. What we have found is when you start to risk more than 5% of your account, that's when you start to get emotionally attached to every swing back and forth. Because your ability to take the next trade depends on the outcome of the trade that you're in currently. Never want to fall into that trap. Keep that risk small. Focus on taking a larger number of small trades. It's all a numbers game. I'm just looking to stack the deck in my favor long term. That's the big key. If you swing for the fences, take on too much risk, all of a sudden a couple losing trades wipes you out. You're out of the game. You can have a system that's doing great long term, but if you can't take advantage of those numbers long term, it does you no good. And then also, obviously, we're all in this game to make money, right? And we want to make as much money as we possibly can. That's why we're all attracted to the markets, and the potential is certainly there. However, don't make a decision whether to take your trade or not, or whether to use a long option or a credit spread solely based off of the profit potential. Focus on what the market is giving you. Focus on those metrics that we talked about earlier. Take what the market's giving you, because long term, again, if you're around for the long haul, the numbers are working in your favor, you're going to see the consistent gains. So many traders just want to hit that big winning trade, right, that changes the ball game for them. Yeah, it could. But if the market's not willing to give that result to you, you're going to struggle, right? So make sure you're focused on taking what the market's given you, not based off of what you hope to make. All right, so again, just to summarize, the long options, great Great way to make some quick returns. Just make sure it's a smaller part of your portfolio. You're going to be better off when you have a good mix of both the long options and those risk-defined credit spreads that give you a higher probability of success. All right, so hopefully you found this video beneficial. Hopefully those metrics that we talked about here over the past 15-20 minutes were beneficial. Please like and subscribe to the channel. We'd love to get you more content. If you do have any questions on topics that you're curious about, let us know. We can certainly get videos made for you. We'd love to get this channel as a good resource for you in your options trading. So I'm going to wrap this video up here. I'll be back with you guys here shortly with our next video. We'll talk to you then.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPicks full risk